Hello everyone. This is the second video of chapter 17, and in this video I'm going to cover the learning objective 2 of this chapter, how firms manage their receivables and credit policies. Look, when a firm sells goods and services, it can demand cash on or before the delivery date, or it can extend credit to customers and allow some time to make the payment. Okay, so why would firms grant credit? That could be a big question. The obvious reason is that offering credit is a way of stimulating sales. The cost associated with granting credit is not small. First, there is the chance that the customer will not pay. Second, the firm has to bear the cost of carrying the receivables, right? The credit policy decision does involve a trade-off between the benefit of increased sales and the cost of granting credit. Okay, so from an accounting perspective, when credit is granted, an account receivable is created. These receivables include credit to other firms called trade credit and credit granted to consumers called consumer credit. And they represent a major investment of financial resources by businesses. Furthermore, trade credit is a very important source of financing for corporations. However, we look at it, receivables and receivable management are very important aspects of a firm's short-term financial policy. Okay, so let's talk about the components of credit policy. If a firm decides to grant credit to its customer, as I mentioned just a few moments back, then it must establish procedures for extending credit and collecting. In particular, the firm will have to deal with the components of credit policies, for example, terms of sales, credit analysis, and collection policy. Okay, terms of sales establish how the firm proposes to sell its goods and services. If the firm grants credit to a customer, the terms of sale will specify the credit period, any cash discount, and the discount period, and the type of credit instrument. Okay. Then credit analysis. In granting credit, a firm determines how much effort to expend trying to distinguish between customers who will pay and customers who won't. Okay, so firms use a number of devices and procedures to determine the probability that customers will not pay, and put together, these are called credit analysis. And last of all, collection policy. After credit has been granted, the firm has the potential problem of collecting the cash when it becomes due, for which it must establish a collection policy. Okay, so we will discuss a bit more detail, a bit more detail now. First of all, terms of sales. As we mentioned in the previous slide, the terms of sales are made up of three distinct elements: the period for which credit is granted. Okay. For example, the basic form of a term of sales is 510 net 45. So it specifies the period for which the credit is granted. Well, for example, credit period. The cash discount, which is 5%, and the discount period, which is 10 days. Okay, so it means that 5% discount from the full price if you pay within 10 days, or else you need to pay within 45 days. Okay. And also the type of credit instrument will be specified. Okay. Within a given industry, the terms of sales are usually fairly standard, but these terms vary quite a bit across industries. In many cases, the terms of sales are remarkably archaic and literally date to previous centuries. Organized systems of trade credit that resemble current practice can easily be traced to the great fairs of medieval Europe, and they almost surely existed long before that. So look at this example. Ordinary tiles are often sold with terms of 310 and net 60. So as I already said in the previous slide, that 310 net 60 means 3% discount will be offered if you pay within 30 days. Otherwise, you need to pay within 60 days. What effective annual rate does a buyer pay by not taking the discount? What would the APR be if one were quoted? So discount rate is 3%, right? And if you do not take the discount, you will pay on 60 days instead of 30 days. So you actually get a 30 days, additional 30 days, okay? And for not taking the discount, so 3% discount divided by 0.97, so rate per 30 days is 3.09. And if we calculate it on an yearly basis, then it's going to be 12.17%. I'm sorry, just let me explain it again. So discount rate is 3%. So if you do not take this discount, you essentially pay after 30 days. So you forgo this 3% discount. So rate for this 30 days will be 3% divided by 0.97, so 3.093. So that's essentially the rate that a buyer pay if doesn't take the discount. Okay, now how many periods? So 365 by 30, because each 30 days the credit period. So number of period is 12.7. Now if we use the EAR and APR formula, we have learned these EAR and APR concepts previously. So the annualized rate will be 37.6%. So if you do not take the discount, do not pay within 30 days, rather you pay after 60 days, you essentially are paying 37.6%, okay? And effective rate is even higher than that, so it would be 44.9%, okay? Now, credit instruments. Credit instruments is a basic evidence of indebtedness. Okay, so most trade credit is offered on open account. This means that the only formal instrument of credit is the invoice, which is sent with the shipment of goods and which the customer signs as evidence that the goods have been received. Afterwards, the firm and its customers record the exchange on their books of account. At times, the firm may require that the customer sign a promissory note. We learned about promissory note earlier. This is a basic IOU, and it might be used when the order is large or when the firm anticipates a problem in collections. Promissory notes are not common, but they can eliminate possible controversies later about the existence of debt. Now, optimal credit policy. In principle, the optimal amount of credit is determined by the point at which the incremental cash flows from increased sales are exactly equal to the incremental cost of carrying the increased investment in accounts receivable. Okay, Now, the trade-off between granting credit and not granting credit is not hard to identify, but it is difficult to quantify precisely. Okay, as a result, we can only describe an optimum credit policy. Okay, to begin, the carrying costs, if you remember, we learned about carrying costs previously. The carrying costs associated with granting credit come in three forms. One is the required return on receivables, losses from bad debts, and the cost of managing credit and credit collections. Okay, so we already have discussed the first and second of this. The third cost, the cost of managing credit, is the expense associated with running the credit department. Firms that do not grant credit have no such department and no such expenses. Okay, so these three costs will increase as credit policies relax. Okay. If a firm has a very restrictive credit policy, then all of the costs will be low. In this case, the firm will have a shortage of credit, so there will be an opportunity cost. This opportunity cost is the extra potential profit from credit sales that is lost because credit is refused. Okay, so this foregone benefit comes from two sources: the increase in quantity sold and potentially a higher price. These costs go down as credit policies relax. Okay, the sum of carrying costs and the opportunity cost of a particular credit policy is called the credit cost curve. Okay. So if you look at this diagram, okay, so point C star, if you see here, point C star, that is actually the point where the total credit cost is minimized. Okay, so you can see here the amount of credit extended. So this is carrying costs and this is opportunity cost. So as the credit, you grant more credit, carrying cost increases and opportunity cost decreases, and some of them are in this blue line. Okay, and this is the optimal level of credit where the total cost is minimized. If the firm extends more credit, then this minimum amount, the minimum amount means the amount that is specified by this point. If firm extends credit, then at more than this amount, the additional net cash flow from new customer will not cover the carrying cost of the investments. So if the level of receivables is below this amount, then the firm is foregoing valuable profit opportunities. Okay, so in general, the costs and benefit of extending credit, in general, the costs and benefit of extending credit will depend on characteristics of particular firms and industries. All other things being equal, for example, it is likely that firms with excess capacity, low variable operating costs, and repeat customers will extend credit more liberally than other firms. Okay. Now, credit analysis. Thus far, we have focused on establishing credit terms. Once a firm decides to grant credit to its customers, it must then establish guidelines for determining who will and who will not be allowed to buy on credit. Okay, so credit analysis refers to the process of deciding whether or not to extend credit to a particular customer. It usually involves two steps: gathering relevant information and determining creditworthiness. So credit information, if a firm wants credit information on customers, there are several sources. First of all are financial statements. A firm can ask a customer to supply financial statements, such as statement of financial position, statements of profit or loss, minimum standards and rule of thumb based on financial ratios, like we learned in chapter 3, can then be used as a basis for extending or refusing credit. Then credit reports on the customer's payment history with other firms. Quite a few organizations sell information on the credit strength and credit history of business firms. The best known and largest firm of this type is Dun & Bradstreet, which provides subscribers with a credit reference book and credit reports on individual firms. Ratings and information are available for a huge number of firms across the world. The Credit Reference Association is the major supplier of consumer credit information. Then the banks will generally provide some assistance to their business customers in acquiring information on the creditworthiness of other firms. And the customer's payment history with the firm. The most obvious way to obtain information about the likelihood that a customer may not pay is to examine whether they have settled past obligations and how quickly they have met these obligations. And the next one is credit scoring. There are no magical formula for assessing the probability that a customer will not pay. Okay. In very general terms, the classic 5 C's of credit are the basic factors to be evaluated. Okay, so those are used for credit scoring. So these 5 C's are character, capacity, capital, collateral, and conditions. Characters, the customer's willingness to meet credit obligations. Capacity is customer's ability to meet credit obligations out of operating cash flows. Capital is the customer's financial reserves. Collateral, securities backing up the credit, and conditions are the general economic conditions in the customer's line of business. Okay, now credit scoring, that was the point in the previous slide. The credit scoring refers to the process of calculating a numerical rating for a customer based on information collected. Credit is then granted on or refused based on the result. Okay, for example, a firm might rate a customer on a scale of 1, very poor, to 10, very good, on each of the 5 C's of credit, using all the information available about the customer. A credit score could then be calculated based on the total. From experience, a firm might choose to grant credit only to customer with a score of above, say, 30. Okay. So this is how a credit scoring is done, and a credit worthiness measure is developed. Then collection policy. Collection policy is the final element in credit policy. Okay, collection policy involves monitoring receivables to spot trouble and obtaining payment on overdue accounts. Okay, so monitoring receivables, to keep track of payments by customers, most firms will monitor outstanding accounts. Firms, for example, first of all, will normally keep track of their average collection period over time. If a firm is in a seasonal business, the average collection period will fluctuate during the year, but unexpected increase in the average collection period are a cause of concern. Okay, either customers in general are taking longer to pay, or some percentage of account receivable is seriously overdue. Okay, so an aging schedule is used in this case. The aging schedule is a second basic tool for monitoring receivables. Okay, so to prepare an aging schedule, the credit department classifies accounts by age. Okay, Suppose a firm has $100,000 in receivables. Some of these accounts are only a few days old, whereas others are outstanding for quite some time. So the aging schedule will show you the proportion of receivables that that are due over a number of days. Okay. And last of all is collection effort. A firm usually goes through the following sequence of procedures for customers whose payments are overdue. So what are these? For example, it sends out a delinquency ledger informing the customer of the overdue status of the account. It makes a telephone call to the customers. It employs a collection agency. Okay, and perhaps finally, it takes legal action against the customer. At times, a firm refuses to grant additional credit to customers until arrears are cleared up. Okay, so that's essentially the end of our discussion on the second learning objective of this chapter. So the next video will be the last video of this week, where we will be talking about the inventory management and optimum inventory level. Thank you very much.